Hello and welcome to my jam-packed May economic and RBA update. And the big talking points for this month are all around global inflation and global interest rates on the back of that global inflation story, and then what the RBA did about it today. Now, I want to start with some economic news, global economic news, and some of the reforecasting that we've seen being done. So the World Bank cut its 2022 growth outlook on Russia's invasion of Ukraine. Their forecast sees growth expected to slow this year to 3.2%, down from the previous prediction of 4.1%. They believe slower growth in Europe and Central Asia is expected to weigh down the overall global growth story. The IMF also joined the World Bank in cutting its global growth forecast in 2022 from 4.4 down to 3.6%, and warned of the risks of aggressive rising of interest rates from central banks on the back of this inflation story. The IMF also sees prices rising 5.7% across advanced economies and 8.7% in developing economies this year in its latest inflation forecast, which is a perfect segue, taking us more into the global inflation story and giving us some perspective. That's what I want to do. I want to give us some perspective in terms of short-term and long-term inflation impacts. And you can't start anywhere else but the impact from the war in Ukraine. So whilst Ukraine forces are doing a mighty job, and with the rest of the world looking on in admiration for them and in disgust of Russia's actions, from an economic standpoint, this war is having a material impact on energy and food prices, causing global inflation impacts that we'll continue to see until the fighting ends and basically peace is restored in Europe again. So I want to expand on that in more detail. Let's talk about some of those so we can get a better understanding for those of us who have a limited understanding of economics. So the sanctions in Russia's oil and gas supplies has significantly lifted the global price of oil gas, which naturally lifts the cost of energy and heating production, such as electricity and those types of things. In addition to that, it also puts costs on transportation as we move goods and services around the world, as we effectively price in the impact of less supply of gas and oil. The other big impact from the war in Russia has been around the grain production. So over 30% of the world's grain, we're talking about wheat and barley and those types of things, comes out of Russia and the Ukraine. And the bulk of the world's fertilizer also comes out of Russia. Now, fertilizer is used to create yield, to improve the yield production on those grain crops. So that is also resulted in large costs around the world for fertilizer. And so every country is getting impacted in terms of the input costs that come together to make up your production of food. So those raw material costs are growing as you see countries and also businesses compete to lock in their prices to guarantee those input costs to produce their food that they do for each of the nations. So in terms of the war in war in Ukraine, that is the big challenge that we've got right now. Now, in addition to that, we're also seeing the challenges that China's got in battling the COVID crisis that they've got over there. So China is a massive exporter of goods, and these goods are currently being locked down on the back of city by city lockdowns as China continues to try for a neutralization of their COVID pandemic. And so they're trying for that zero strategy, and it's not necessarily working. So that's closing down big cities like Shanghai and some of also the technology centers, and now it's also into Beijing. So we're definitely seeing a problem here in terms of those supply chains are definitely causing limited opportunity to get some of those essential goods out. Now, when there's limited opportunity, what you do see is companies pay more to get those goods. They're competing with the factories to basically get their goods out. So that is naturally flowing on to the prices that we pay as consumers. But I'm not done yet on this inflation story. many countries around the world, to get through the 2 main years of the pandemic, pumped stimulus. They pumped cash into the economy to get the economies moving and avoid collapsing, and keeping people employed. So the net result has been a huge increase in household savings. And so we've seen great amount of household savings, and that's terrific, as obviously wages kept coming in, or the government kept you paid in terms of the borrowing money with the stimulus that they did. And the second part of that is you've got a huge amount of this global savings, which is spending power, but we were locked down. So we weren't able to go out and spend that money, hence the result in those huge savings. So once countries started to open up their economies again and, allow people to move around, we saw a huge spike in that demand story in terms of, people wanting things from couches to computers to any types of goods and services. So we got a crunch when it came to the supply chain story there. So households were cashed up, but they weren't able to spend that money. Now, in addition to the government stimulus and the household savings, the reserve governors and boards and all of the central banks around the world also reduced interest rates. Now, when you reduce interest rates, you make money cheaper. Now, that has two important effects in terms of helping local economies survive. Firstly, it reduces the cost to businesses, and that obviously means keeping people employed, but it also reduces the cost to households. So you reduce the cash flow rate or the interest rates that people are paying. That means that repayments are obviously going to be lower. So when they become lower, you ultimately also see the other benefit of that, and that is people say, well, I've got gainful employment, repayments are going to be lower, maybe I'll go out and buy some assets. Maybe this is a good time for us to add to our wealth. And so we saw that as an example in terms of property purchases. So we have seen right around the developed world a real spike in property prices on the back of lower repayments, which is on the back of lower interest rates. And it also, lower interest rates increases your borrowing power. So that's what we were talking about here. So let's recap. So we've got the war in Ukraine, which is resulting in higher energy prices, higher transport and food costs. We've got China's lockdown, supply chain shortages, bidding up of prices of imports and also moving those goods. So the supply chain bidding up of freight costs and transport costs, government stimulus in terms of printing and borrowing money and obviously reducing interest rates. But I'm still not done yet. The final part of the inflation story relates to employment. When you lock down countries, you lock down an important resource, which is a labor supply resource, which is immigration. So what we see here is, a lot of the developed and wealthier countries, they often bring in temporary labor or permanent immigration into countries to continue to refresh their labor source, their human capital. And so what we did see during the pandemic is most countries closed their borders, and that meant that immigration couldn't occur. And so we then saw a reduction in the labor force. Now, this is showing up in record levels of unemployment right across all of the developed world. And we are seeing, the re-establishment of those people coming in to do that seasonal work. So in a lot of wealthier countries, a lot of the work that these new immigrants potentially do aren't work that the established citizens of that nation want to do. So we're talking about, things like fruit picking, hospitality, beverage, food and beverage type works and those types of things as well. So when you see this happening, you're basically seeing that because there was none of this extra labor force coming in, this human capital, that starts to put pressure on wages. And you start seeing businesses having to offer to pay staff more to retain them, because effectively, it becomes a buyer's market for anyone who wants to move around in terms of doing work that they want to do to get paid more. So that's what you saw in terms of the employment story. But in addition to that, you are seeing higher wages growth. Now, higher wages growth is a good thing in part because it also means that those lower income workers earn a little bit more, which is great news. In terms of making sure that they can continue to live in a society if inflation exists. So their borrowing power, their spending power continues to keep up with the cost of living. That is a good thing. But ultimately, what you also see there is if consumers are getting more money, that also means that it increases their ability to spend more as consumers. And that also gives a bit more of that sort of demand pressure that we see around that. So, that's a pretty good summary in regards to, all of these factors that we've seen come together, which is putting this in very simple terms, why we're seeing this spike in global inflation. Now, that's the cause and effect that we are seeing, but I want to keep moving forward on this conversation and this update. I want to take a deeper dive into this global inflation story, because while that sounds scary, and it's definitely in the short term going to mean, ultimately the cost of living is going to go up, let's ask some critical questions about when all this starts to settle down, and what ultimately does that mean for inflation over the medium to longer term. So based on what we've learned, I want to answer some of those questions. So here we go. Will the war in Ukraine go on for an extended period of time? Say another couple of years. Well, wasn't Russia saying that this was a special military operation and they didn't want a prolonged war? So even though it does look like it's going to go a lot longer than they had hoped for, hopefully we can get to a resolution. So we may not necessarily see this war continue on for an extended period of time into many, many years. The reason for that is obviously Russia has all these economic sanctions on them. So their own economy is being crippled by what's happened in terms of the sanctions that the rest of the world have started to put onto Russia. Now, that's also causing internal challenges for the Russian government in terms of their people. Are they going to be, willing to keep putting up with this in terms of losing their jobs and losing their standard of living because the Russian government wants to have a war win in Ukraine? So that is one point. Now, also, if the war does end, what does that also mean to oil prices? Will they come down? Well, logically, that's one good reason why prices will come down. Russia will continue to sell their oil into the open market, and that should obviously see, prices come down potentially as sanctions start to lift. In addition to that, when you also get a situation where you've got rising interest rates, which is technically designed to slow down economic activity, you usually see oil prices coming down because global growth is slowing. What we saw earlier in the IMF and the World Bank update. So you're going to start to see that type of thing happening as well. So what we've got here is, does that mean that petrol prices will start to fall? Well, you'd like to think the answer to that is yes. That will definitely happen as you start to see, will you start to see transport costs being reduced because oil prices have gone down, petrol prices come down? Well, the answer to that should also be a yes over the medium term. Can Russia keep producing grain harvests? Well, that's a good story around the food inflation that we're seeing. Well, the answer to that is Ukraine is not planning to invade Russia. So you'd like to think that the Russian farmers can continue to produce their grain harvests. And then when you think about, okay, well, what's happening in Ukraine, the way in which you look at the maps, you think that the war is going on everywhere. But also Ukraine is a very, very large landmass. And you would like to think that there's also still opportunities for some farmers to be producing grain, also for feeding the Ukrainian people who are obviously battling the Russians. So you'd like to think that maybe that sort of fear of the shortage of grain around the world will surpass or may have been exaggerated. So you could potentially see the cost of grain coming down over the next couple of years as people work out just exactly how much grain has been planted as you see Europe starting to come into their spring and summer months. So we will see what happens there. Now, regarding the energy inflation, this might take a couple more years to play itself out. So what we are seeing here with Germany refusing to take gas and oil and potentially looking for alternative sources of energy, future energy, that could obviously be renewables. Potentially they'll renegotiate or redebate nuclear as part of that story. So all of a sudden now you'll see over time when that resolves itself is hopefully you'll see energy prices coming down from these current highs, which is also being caused by the war in Ukraine. Will China eventually learn to live with their deadly virus or less deadly virus strain that is COVID now? So the answer to that is, they should, because we all know that, because of just how infectious these new strains are, it's near impossible to keep COVID out of your country. So as they learn to live with that and they potentially open up, you'll start to see a lot of those demand shocks and supply shocks starting to slow down in regards to that. So China will eventually learn to live with that. So that's very true. In terms of what about the goods that they are producing in the supply side, will the demand for the goods now that are being challenged still be wanted by consumers in the next 6, 12 or 18 months? Will they have an oversupply of goods as we start to see the supply shocks start to settle down? So from my point of view, I think there's potentially also, when you're seeing higher repayments in households, their discretionary spending is also going to reduce. So when that discretionary spending reduces, you start to also see less demand for those goods and services. So if China's got a stockpile of things that are no longer in demand, they'll flood them onto the markets, and that will also reduce some of those costs of those goods and services that they may have produced when demand was high, but by the time they were able to supply it, then maybe no longer in demand. So that should take a little bit of pressure off goods and services in terms of inflation. And then finally, in terms of, we're talking about national borders, we are starting to see nations, including Australia, where we are starting to see immigration and our borders opening. So we're going to see more and more of those immigrants starting to come in, and that's going to take pressure off the labour market. So from my point of view, when I put all of those things together, I'm asking myself, do I see inflation hanging around for the next sort of 2 to 5 years? Well, my view is absolutely not. I cannot see that playing itself out over that extended period of time. So what I can see is certainly over the next 6 to 12 months, it's going to take time to wrestle that genie back into the bottle. But after that, I'm then starting to see inflation get back into a reasonable area. And that is because energy prices will correct themselves. Supply chain bottlenecks will resolve themselves. Wages pressure will start to ease as new immigration arrives. New technology, and I've talked about this before, digitization, automation, which will require less human capital over time, will also put pressure on inflation in a downward way. So all of those things for me talk to a story of lower inflation over a sustainable period of time. So I'm not too worried about medium to longer term inflation. And in terms of the investing or the decisions that I'm making are also based on that view that I do see inflation being not around in the sort of next 3 to 5 years. Okay, so that's a fairly large wrap when it comes to talking about the global spike in inflation. Let's now, go back to our regular programming, looking at the US markets and the global markets that we talked about first. So starting with the US, interest rates first up, the Federal Reserve is widely tipped to increase the cash rate once again by 50 basis points tomorrow at their meeting, depending on when you're listening to this recording. This is trying to deal with their record high domestic inflation levels that we've already focused in on. In addition, the markets are tipping that the Fed will increase their cash rates again in June and July to slow down that current inflation run. Many believe that their cash rate will be around 2.25 to 2.5 by the end of the year, or even possibly higher if they can't get in control of that inflation story. Now, their GDP numbers did surprise. So based on the latest March GDP numbers, the data said that the US economy shrank for the first time since 2020. In the March quarter, the result surprised those economists, and consensus forecast was pointing to a 1% gain. But what actually happened is that it went backwards. In annualized terms, GDP declined 1.4%, following a 6.9% growth at the end of last year. Now, context, people, we always need to get these things in context. This March reading is more reflective of how GDP calculations can be volatile quarter to quarter on the back of stop-start bouncing in quarterly data when you're opening, closing economies, or a wave of the pandemic is moving through at that time, whether it be the Omicron wave and so forth. So most economists don't believe that this will stop the Fed in their planned cash rate tightening, because they believe it's an anomaly. It's not necessarily where it's moving forward. In positive news, consumer confidence was slightly softer than expected in April, stabilizing at 107.3 from a revised reading of 107.6 in March. This compares to the median consensus forecast of 108.2. Confidence remains solid as stronger labour market conditions outweigh inflation concerns. Closing out the US data for the month, and in another positive news, the housing boom in the US continues. I mentioned this earlier. Low cost of money has led to housing prices increasing at their fastest monthly pace on record in February, despite rising affordability pressures and rising borrowing costs. The FHFA house price index jumped 2.1% in February, the fastest monthly pace on record going back to 1991. This follows a 1.6% jump in January. The S&P CoreLogic House Price Survey revealed a 2.4% monthly increase in dwelling prices, the fastest monthly pace on record going back to February 2000. Both measures beat consensus expectations of a 1.5% monthly rise and recorded the 21st consecutive month of house price growth coming out of this pandemic. Now, what is interesting about that is obviously that's past data. Let's see what happens to property confidence with these forecast 350 basis points rise that we're going to see in May, June, and July, based on most economic forecasters. So the US market's looking a little bit mixed in terms of its economic data. Turning to the China story, GDP for China rose by 1.3% in Q1, slower than the 1.6% pace that it recorded in Q4 of 2021. On a year ago, GDP growth grew by 4.8% in Q1, up from 4.2% in Q4 of 2021. Growth has remained pretty resilient despite COVID restrictions and supply chain disruptions. However, as discussed last month, there is a greater downside risk to growth due to lockdowns in major centres across China. Industrial production year-to-date in March expanded by 6.5% from a pace previously of 7.5% in February. So industrial production has slowed every month since last February, when it was growing at a astonishing rate of 35.1. Again, and there's no mystery as to why there are slowdowns occurring in the Chinese economy, and it's got everything to do with COVID and also their own supply chain challenges in terms of getting those raw materials. Retail spending in March fell by more than expected, down 3.5% year on year compared to expectations for a smaller fall of 3%. This is the first fall since August of 2020. On the back of the forecast slowdown in economic activity, the People's Bank of China announced 23 measures aimed at supporting individual and small businesses amid economic headwinds. These programs are expected to boost bank lending by 1 trillion yuan, or 157 billion US dollars. These measures include more credit for people with flexible employment, like taxi drivers and online resellers, and also, longer term, cheaper loans for small to medium-sized enterprises. Finally, rounding out the China story, again, on the back of that stimulus, stimulating a slowing economy, it's being reported through Beijing that they are set to ramp up key infrastructure construction spending in an effort to prop up the slowing economy, which is also another part of their stimulus program that they're trying to implement at the moment. Okay, looking to the Eurozone, I'm always interested in the Eurozone now because obviously of what's happening in the Ukraine and Russia. Starting with their inflation story, here it is again, everyone. Their CPI jumped 7.4% over the year to March, up from 5.9% annualized since February. Core inflation, which excludes volatile items such as food and energy, rose 2.9% in annual terms. This has led to the European Central Bank, the ECB, Vice President noting that rate hikes could come as soon as July to slow inflationary fears. In some good news for the region, consumer confidence stabilised slightly in April, beating consensus expectations of a further deterioration in sentiment. consumer confidence increased to negative, so it's still pretty ordinary, negative 16.9 from a negative 18.7 in March, as Europeans settle in for a protracted war in Ukraine, for now at least, after this initial hit to confidence when the invasion began. Okay, here we go. We're now turning our attentions to the local Australian economy. And yes, the Reserve Bank Board met today. And on the back of our own spike in March in our CPI inflation read, the RBA decided today to bring forward their cash rate move and start the first cash rate tightening cycle in 11 and a half years. That's right, way back in November of 2010, when the cash rate was increased from 4.5 by 25 basis points to 4.75. And since November of 2010, all the cash rate has done is move lower until today. So from today, we're moving off these emergency setting levels of 0.1 of 1% and heading north. Now, don't worry too much about what today's increase is, because it will not be short-lived. It will not be one and done. If I'm right, along with many other economic commentators, after next month's June meeting, the cash rate will be at 0.5 of 1%. So today's increase will only be in play for less than a month, okay? And ultimately, it will only impact our mortgages for a short period of time. So, as mortgage holders, we need to now focus in on what does that mean for us? So what are the banks going to pass on to us? Now, I expect, depending on the day and time you're listening to this or watching the recording, the first of the big banks will have already announced their changes to their variable interest rates. And I suspect that they will also be making that effective immediately, which is their typical form when rates are rising. They are slower to pass on any cuts, but they are very much true to form when they pass on increases immediately. So building on that, hopefully you're with a good bank or a good lender, and they only pass on the same increases the RBA has passed on today and next month and no more. So don't be shopping around just yet. Maybe wait for another month to see basically where it all plays out. So therefore, what you'll be needing to plan for is a 0.4 of 1% increase in your variable interest rates by the end of next month. And then looking ahead, the best case scenario for me is around a 0.9 increase, which brings the cash rate to obviously 1%. That's best case. Worst case scenario, where the cash rate by the end of the year is sitting at around 1.4%. And obviously, again, you add your bank margin on top of that in terms of what you pay in your interest rates. So meaning effectively that the RBA cash rate will be sitting at between 1 and 1.5% at the end of the year is sort of where I see the markets and what, reading all of the forecasts from most economists, that's where they also see it sitting as well. The market believes it's actually going to be higher than that, but I'm not so sure the market has it right. Now, what does this mean for a typical mortgage? Let's get down into the numbers and let's keep it really simple. So for every $100,000 of borrowings, a 0.1 of 1% increase is $100 per year, or $8.33 per month in terms of interest charge increases. Now, if we're talking about the cash rate increasing by 0.9 by the end of the year, and your bank doesn't pass on any extra, for every $100,000 in borrowings, that's $900 or $75 per month. So rounding out this example, by the end of the year, if the cash rate is sitting at 1.5, meaning that the increase over the year has been 1.4, then that's $1,400 in additional interest charges, or around $116 per month for every $100,000 that you've got. So if we say it again, a 0.9% increase to a cash rate of 1% is about $900 a year added for every 100,000. For a 1.4% increase until the end of the year, you're talking about $1,400 or about $116 per month. Now, if you want to get a better understanding of the impact of your household cash flows, can I recommend you check out our Money Smarts money management system but also another cool feature that we have on our My Wealth portal, which is called Money Stretch. Now, what this Money Stretch feature allows you to do is it allows you to adjust your repayment levels, and that will show you the impact in terms of your cash flow. Will you still be saving money? Will you be breaking even? Or will you start to encroach on that savings level if you keep up your current spending? So if you want to check that out, for Empower Wealth clients, you just go to ew.moneysmarts.com.au, and for our Property Couch listeners, you would go to tpc.moneysmarts.com.au, and it's a free account. So check it out and you can potentially get yourself organized with your financial affairs. Okay, so why did the RBA move on the interest rates earlier than expected? So, well, unless you've been living under a rock, and what we've been talking about here today, it's all on the back of inflation. Okay, so I've already gone over the macro drivers in terms of the global inflation story, but in the March quarter, what did we see that surprised the governor and the board is how quickly inflation has arrived here in Australia. So in the March quarter, the headline consumer price index rose by a surprising 2.1% in quarterly terms to be 5.1% in annual terms. Now, this is the hottest reading in quarterly and annual terms since the GST was introduced in the early 2000s. Now, when you take all of the sort of volatile numbers out and you look at the trimmed mean inflation, which does strip out those volatile changes, it still rose an uncomfortable 1.4% in the quarter, and that's what allowed the RBA to pull the trigger. And it's been the biggest quarterly jump since December of 1990 to be 3.7% higher in annual terms. Along with all of these issues I spoke about in the update earlier, let's look locally. You can also add price pressures internally around New South Wales and Queensland flooding that occurred that impacted the food prices in those particular regions. So the concern now for the RBA is all around annual non-discretionary inflation, which hit a huge 6.6%, which means more than double the discretionary inflation consistent with the price impacts consumer staples spending. So let's have a look at what we're talking about here. So let's run through this non-discretionary stuff and these discretionary items. So non-discretionary, food was up 5.1, transport was up 13.7, education was up 4.7, health was up 3.5, alcohol and tobacco 4.3, recreation is up 3%, and housing is up 6.7%. So that's that non-discretionary number, which really did force the RBA's hand that it's not necessarily inflation into those discretionary items. Okay, let's now look at wages and the unemployment story. I want to start, this section just to remind it that Governor Stevens was hoping, as was I, for the record, that we would have seen improvements in the wages growth before the RBA board had to pull a trigger. Now, you may be hearing in this election period that wages aren't growing. Well, they actually are growing. They're growing at around sort of 2.4%, but it's not as high as what is inflation's growing. So the net result is our money doesn't buy us as much. But I was hoping that they would be able to hold off until they got that data read. And the next wages data read is going to be on the 18th of May. So that is something to keep an eye out for, because I definitely want to see that wages growth before we saw those inflationary pressures trigger the higher cash rate. In terms of the unemployment data, in the absence of that wages data, the labour market continued to run in great form. It's the fifth consecutive month for jobs growth, adding an extra 17.9 thousand jobs in March. So if we were to go super technical here, we saw the unemployment rate with a 3 in front of it. It wasn't reported that way, and that's because the ABS only report unemployment data to one decimal place. But if you actually unpack it further, the unemployment rate is technically 3.95 in this March data. So that's quite interesting. In terms of the previous month, it was at 4.04, but you heard it saying it's at 4%, and you're still hearing in terms of the public reporting that it's currently at 4%. In other good news, in the unemployment data, it is everywhere. So these are the highlights, and when it comes to our current unemployment story. The improvement in the unemployment rate has also fallen from the COVID-19 high in March 2020, which had a reading of underemployment of 9.3%, to now down to this reading of 6.6%. So no one can argue that, oh, that's because less people are looking for work. It's not the case. Okay, now what we are seeing here is unemployment rate now under 4% is because less people were looking. No, as I said, it's not the case. Right now, there are more people participating in the workforce. We did see hours worked decline by 0.6 in the month to be just 1% shy of an all-time record. Demand for labour continues strong across the economy. Job vacancies rose to be above 3% of the labour force in February 2022, the highest level on record. Job ads increased to their highest level since 2008. So in summary, the job story is this: the overall increases in jobs elevated the level of full-time and total employment to new records high. In other words, there are more people employed in Australia than ever before, and we can only expect that next month's the unemployment rate, which is this month we're seeing now, will have a 3% read on that. So that is awesome news. In terms of consumer confidence and sentiment, we need to be mindful that these results were collected prior to the big inflation data read and the big news event that we saw last week when those CPI numbers hit. But consumer sentiment declined for a 5th consecutive month in April. Consumer sentiment index fell by 0.9% to be 95.8 points, its lowest level since September 2020, when Melbourne was in an extended lockdown. Key concerns for people in this reading was cost of living pressures, prospects of higher interest rates, the flooding and major weather events across parts of Queensland and New South Wales, and the ongoing war in Ukraine. Also, the associated spike in petrol prices, in regards to those higher oil prices coming through. What was interesting in the data was the imbalance between short and longer term outlooks. So the current conditions index declined by 5.1 to a reading of 88.8, while the expectations index increased by 1.8 to a positive reading of 100.4. So on a side note, I'd be interested to see the impact of the federal election, given potentially, how tight the result may be. So it is going to be interesting in terms of how we carry that confidence through on the back of the election, on the back of raising interest rates, and also these inflationary and cost of living concerns. It's also an emerging split between confidence in rural areas, which fell by 8.6% compared to metropolitan areas, which rose by 3.2%. Now, this is a likely effect of obviously the floods, but also what I am definitely seeing here in Melbourne is more people getting out, those restrictions being eased and people getting back to their normal lives and their freedom. So that could be playing a result in terms of city folk being more confident and comfortable about the conditions and the economic activity than what we are seeing in regional areas. Business confidence and conditions, what we did see here, it's a really positive news. So this also gives me more confidence about the overall economy. Business conditions surged 9 points to be plus 18 in March, which is the largest month-on-month jump since June 2020. Business confidence rose 3 index points to be plus 16 in the month. So conditions and confidence are now both well above their respective long-run averages, which is a very positive sign for the overall economy in the short term. Notwithstanding that, and acknowledging at the same time inflationary pressures are rapidly heating up. The cost and price pressures in the business survey also reached record high levels in March too. So we've got to balance those things out. Again, overall, this is a good data and overall picture for business. They are certainly reporting some challenges: labour, staff shortages, supply disruptions, and also those price pressures. So to get a read like that is really impressive. So finally, this is also supported by a recent Westpac survey, which reported that 72% of small business leaders expect their sales to grow in the next year. So let's hope that does materialise and we see a stronger economy over the course of the next 12 months. Now let's turn our attention to property on the home stretch now. We turn to the core logic hedonic index reading for April price dwellings data. As predicted, we did see a story that it is going to be a markets within markets as we go around the capitals and the regional areas. We saw the overall national dwelling value growth of 0.6 for the month on the back of stronger combined regional values growth of 1.4% in April. The combined capital cities saw price growth of 0.3 of 1% for the month, and the overall price growth is slowing from its peaks. As we see, the speed of growth is starting to slow, and that has been reported widely. Now, this isn't a bad sign when, I made it very clear before that I felt that the speed of growth was unsustainable. And so hopefully we're moving to that next phase of measured or slowing growth, more so than any type of severe property correction. So let's round out the different cities for the different months. So Sydney, -0.2, Melbourne was flat, Brisbane was up 1.7, Adelaide up 1.9, Perth up 1.1, Hobart down -0.3, Darwin up 0.9, Canberra up 1.3. So combined capitals overall up 0.3 of 1%, combined regionals up 1.4 mentioned earlier, and nationally overall up 0.6 of 1%. How would I summarise that? Overall, Southeast Queensland, including Brisbane, continues to do well. Adelaide is still performing nicely, although again, they are certainly coming off those peaks of growth speed. On the other side of that story, Perth and Darwin appear to be picking up in terms of their speed as well. So it's starting to see again this sort of markets within markets as we look around for those capital growth returns. Hobart had the biggest monthly fall in prices, and again with interest rates on the rise, I watch this with interest as we potentially see those trends continuing, which I expect that they will for Hobart. So what does this mean for buying over the next 12 months? Well, in simple terms, picking good buying locations are going to become harder. So it's definitely going to be harder to pick those better locations where you might be able to achieve some short-term growth. No longer is it going to be a case of picking any market if you want that short-term growth, okay? You want to be able to, in the past, it was easy the last couple of years, really anywhere you bought, property prices were growing. So, the detailed level of research that you undertake to better understand the levels of demand and supply in a particular market is going to be critical for you. Either that or get a professional to help you to do the buying for you, okay, is my advice. I can definitely see people, potentially stepping away from the market, which they shouldn't be doing. What they should be doing is potentially getting help in terms of locating those better markets, because you're buying property for the long term, you're not speculating on property. So as I close out the property section update, next month in my update, I do plan to spend more time in unpacking the whole economic story and how I believe that's going to impact property prices, because make it very clear that the media is going to be playing up this price correction, and that is going to be impacting on a lot of people. But really, you want to be trying to get your advice from those people in the know. And so let's see how we can, put together an economic story and thesis that will support not only ongoing growth in some markets, but also, where we're going to land in terms of any further corrections. So let's wrap up the whole May economic and RBA update. What do we cover off? Yes, inflation has spoilt the global economic recovery party, and growth will slow thanks to, really the catalyst that pushed us over the edge there was Russia and its invasion of Ukraine, which has really impacted inflation. And we're going to see more of that. Without the war, I didn't think we would be in a situation that would take inflation to that sort of level. In terms of interest rates, well, yes, this tightening cycle of monetary policy is going to happen around the world. So we need to get used to that to ensure in our own household budgets that we have them in order. And we need to make sure that, we've got that surplus cash flow in play, in terms of being able to look after that. Most households, from obviously the level of savings that they've got, are well prepared for this change. The big question really is, are you? Now, if you're not, or you want to get better line of sight, because remember, making the invisible visible, getting an understanding of your financials and your budgets is also a great idea. So a final reminder to you all that if you're interested in using a free online tool, then there's no better place to start than the My Wealth portal, which has the Money Smarts money management system and also our Money Stretch tool in there as well that can help to get that. Now, if you're not sure of those URLs, they'll be in the show notes, but also just Google My Wealth portal. You'll see it come up as one of the top Google ranking services in Australia. So that's it for now. It's been an epic, jam-packed, big session to get through. I appreciate you hanging around till the end. But until next month's update, just remember, knowledge is empowering, but only if you act on it.